Innova Captab Limited Q4FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Lohariwala, Managing Director of Innova Captab Limited. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining our earnings conference call to discuss the operational and financial performance for Q4 and FY24. On this call, we have been joined by Mr. Lokesh Basil, CFO, and SGA, our Investor Relations Advisor. I hope everyone has had an opportunity to go through the financial results and investor presentation, which has been uploaded on the stock exchange and on the company website. I will give you a quick overview of our year gone by, and then Mr. Lokesh will take you through the operational and financial highlights. Since many of you are joining the call for first time, let me give you a short brief description about the company. Innova Captab is an integrated pharmaceutical company in India with a presence across the pharmaceutical value chain, including research and development, manufacturing, drug distribution, marketing, and exports. FY24 has been a landmark year for the company as we got listed on Indian Stock Exchange in December 2023. As a domestic CDMO player, we cater to India's top 14 out of 15 pharmaceutical companies. We have license to manufacture products through 4 state-of-the-art manufacturing facilities at Baddi, Himachal Pradesh, Dehradun, Uttarakhand, and at Taloja, Maharashtra, while maintaining WHO GMP, EU GMP, UK MHRA, and other major registrations with these facilities. With the support of our world-class manufacturing facility and a reliable supply value chain, we are continuously working to maintain high efficient operations. The foundation of our company is our in-house R&D, which helps us to focus on build our product portfolio. Continuous development in quality and regulatory requirements are currently causing challenges for the pharmaceutical industry. We at Innova take the changing dynamics as an opportunity, and with a quality-first approach and with the rigorous protocol of our domestic and international customers, Innova has been adhering to all quality and regulatory requirements since inception and continuously try to further improve our progress. Coming to 4 major business area performances. Contract development and manufacturing, CDMO. Our CDMO business continues to get good attraction. While the demand continues to remain strong, lowering API price have had an impact on our business performance as compared to last year as we do a cost-plus model. We are looking forward for next financial year and quite optimistic that the CDMO business is expected to grow on the back of decent visibility in demand. As on FY24, our number of CDMO customers is at 193. Revenue contribution from the business is nearly 58% in FY24. Domestic branded generic. Our domestic generic business performance has improved backed by our constantly increasing pan-India network of distributors, stockists, and pharmacies. Revenue contribution for this business is nearly 18% in FY24. International branded generic. Our international branded generic product business is focused on export to emerging and semi-regulated international markets while expanding our business to regulated markets like the UK, Canada. We had exported our branded generics to more than 20 countries. Revenue contribution from this business is nearly 11% in FY24. Sharon Biomedicine. In June 2023, we acquired Sharon through CIRP process. Sharon has strong CDMO formulation manufacturing capabilities, including API and manufacturing, and it caters majorly to international markets, including Canada, UK, Europe, Australia, Korea, and Vietnam. Revenue contribution from this business is nearly 13%. Recent development. Our greenfield plant in Jammu is on track, and by Q2 FY25, we are expecting to commercialize and commence operation in all 4 blocks, that is, cephalosporin, penicillin, penem, and BFS, to manufacture oral solid dosage, dry powder injectable, dry syrup, BFS, large volume, small volume parental, respiratory products, and revenue ramp up is expected from Q3 FY25 onwards. The company will benefit from the new central scheme for industrial development of GMDs. In addition to our existing R&D center in Baddi, the company is also establishing a new R&D center in Panchkula, Haryana. Also, with the acquisition of Sharon, we aim to create long-term synergy with additional product offerings like formulation and API. Over the last 3-4 years, we have grown at a healthy rate of 20% plus CAGR, and with our upcoming Jammu facility and recent Sharon acquisition, we are positively looking forward to maintain the same 20% plus CAGR in the next 3 to 4 years. As a company, we continue to drive sustainable growth by exploring new opportunities and focusing on value-added products. Indian pharmaceutical companies are set to experience significant growth in mid to long term, as both domestic and global manufacturers seek reliable and sustainable suppliers like us. I now request Mr. Lokesh to take you through the operational and financial performance for the Q4 and FY24. Over to you, Lokesh.
Thank you, sir. Good afternoon, everyone. Q4 and FY24 has been a good quarter for us, as all our key products witnessed healthy demand. The financial highlights for Q4 FY24 are: our total income stood at around rupees 268.3 crores, with a growth of 10.2% on a year-to-year basis. The business mix for the quarter are as follows: CDMO contributing 53% for the quarter, domestic branded generics is at 18%, international branded generics is at 11%, and the balance of 18% is contributed by Sharon, which is into the business of formulation and GPI. EBITDA came in at rupees 43.8 crores, showing a growth of 48.7% on a year-to-year basis. EBITDA margin stood at 16.7%, as against previous year of 12.2%. Profit after tax for the quarter came in at 28.7 crores, with a growth of 66.5% on a year-to-year basis. The FY24 highlights are as follows. Total income for FY24 came in at rupees 1,083.8 crores, with a growth of 16.9% on a year-on-year basis. The business mix for the year are as follows. The CDMO contributed 58% for the year, domestic branded generic is at 18%, international branded generic is at 11%, and the balance of 13% is contributed by Sharon. EBITDA for financial year 24 came in at 156.9 crores, with growth of 35.9% over last year. Profit after tax for FY24 came in at rupees 94.3 crores, with a growth of 38.9% on a year-on-year basis. For FY24, our net cash generated from operating activities stood at rupees 156 crores, as against rupees 67 crores in FY23. We are delighted to inform you that utilization of our IPO proceeds is on track as per target utilization committed in the IPO prospectus. Excluding the term loan borrowed for our Jammu project, we have repaid all our existing debt. With this, I would like to conclude the presentation and open the floor for questions and answers. Thank you very much.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ameya from JM Financial. Please go ahead.
Yeah, thank you for taking my question. The first question I have is on the CDMO piece. I understand that there is a pricing decline during this year and we have to pass it on. So is it possible for us to give breakup in the volume and the pricing for CDMO piece for the quarter and for full year? And also I've seen the decline has sharper during this quarter. So should we assume that the prices have dropped sharply over Q and Q for the business? Thank you.
Thank you, Maya. So there are two parts of the question. One is that the price correction and the other is the volume growth. So historically, if we see quarter 1 and quarter 4 are the lower quarter and Q2 and Q3 are the upper quarter. So if we take 100 as the base, then generally the Q1 is like 20-23%, because Q4 also is like 23-24%, where the Q2 and Q3 are generally at the higher level of the yearly phase. So one is that if you compare the Q3 with the Q4, there is always historically, if you see the previous quarter also, the number declines in that also. And the second is there is a API price correction. So due to that, as we are working on the transfer cost plus model, and there is benefit is passed to the customer, due to this there is a decline in the top line. But there is a healthy growth in EBITDA and PAT. So this is that witness that there is a volume growth in the volume.
Right.
So Lokesh can focus on the volume growth.
Right. So the reason I ask because going ahead, for this quarter, has the pricing gone down again from Q1 That's the main question, because that will have impact into going into FY25. That's the reason I asked.
Yeah. So if you compare year on year, there is a price decline. The base is lower due to the price decline. And if you compare Q and Q, so we cannot say that there is a 10% price decline. So what we can do is 2-3% price decline, and yearly compare then there is a 6-7%, 8% price decline.
Okay. So going into FY25, now the base is set here. So do you expect a growth for the CDMO business if the prices are stabilized at this level?
So what we can say, Maya, that volume should grow like 10 plus in double digits, whereas pricing impact we cannot speculate. So if the pricing impact is say on the positive side, then the top line growth will be more than like 15-20%, and the price erosion continue. Then it can nullify the volume growth. But overall, as you see, our EBITDA is not linked with the top line. EBITDA is linked with the unit margin.
Right. Sure. The second question I have is on the GM improvement. Throughout the quarter, we have seen, across 4 quarters, we have seen there is a gradual improvement in the gross margin. So is it solely led by the API pricing, or is our export business or the branded generic domestic gross margins are significantly higher than the CDMO?
So I like to highlight one more thing, that gross margin depend on the product mix also. So say if the product mix changes towards the lower cost product, then our EBITDA or the gross margin increases. So it's a hybrid or complex scenario that how the top line and EBITDA come out. So it is very difficult to analyze as we are manufacturing more than 400-500 products.
Okay. So should we assume that this is led by product mix and not the business mix?
So if we historically compare, like our CDMO business is at a lower margin comparing with our own Univentis Medicare, on generic business, and the SDML business, Tenon Biomedicine business. So with the addition of SDML also, it helps us in improving our margin.
Sure, sir. And this last question, if I can squeeze in this Jammu plant, the block which is getting commissioned in Q3, what would be the gross block for that block which is getting commissioned?
So in Q2 we will start all 4 blocks, and the size of block will be approximately 450 crores.
460 crores. Okay. And how fast we expect to optimally utilize this 460 crore block?
So once we start, we are having a good visibility. We are discussing with our existing customer, and we have a very good feedback from all the existing customers. And we are eagerly waiting to start the commercial production. So we expect that once we start the commercial production, down the line after 4 to 5 months, our revenue should start ramping up.
Sure, sir. Thank you so much. I will join back. Thank you.
Thank you. The next question is from the line of Lakshmi Narayana from Tunga Investments. Please go ahead.
A couple of questions. First is, what has been the revenue from Sharon last year, and what has been the revenue contribution? I think revenue contribution this year you mentioned. So how the company has actually grown in the last 1 year?
So basically you're talking about Sharon, right?
Yes.
Yes. So basically, we acquired Sharon on June 23. So we acquired Sharon through CIP process, and it was in the ITC for last 4-5 years. So before acquisition, during the FY23, they had clocked a full year revenue on 192 crores. So this year, on a full year basis, they had clocked a revenue of 190 crores. So while the revenue seems flat on a year-on-year basis, but after acquisition, we have started our efforts to strengthen our pipeline, start working on adding new products to the basket, as well as working on new customer addition to the team. And we are very hopeful, since it's in export business and the gestation period to bringing on new customers on board or introducing new products is slightly higher. It may run into years also, but we are very hopeful that the effort that we have started putting in after our acquisition will start fructifying in coming periods.
Sorry, okay. Your voice is a little unclear, so if you can just slightly stay away from the mic, better. So it's a little noisy to me. So the second question is that this CDMO, India CDMO business, which has shown a underwhelming performance in the last 2 years in succession, if I look at it. how does it compare with the industry? So when I talk to the industry, already one player is listed, one player has actually filed the DRHP. So I just want to understand whether it's an industry issue or a client-specific issue or our company-specific issue, or is it reflective of the industry in general? However, you talked about the pricing scenario. I just want to hear your thoughts.
So, CDMO, this is our business is basically in CDMO category focused on the domestic business. Is it I'm clearly audible?
Yeah, it is audible.
Yeah. So our business is basically domestic CDMO focused business. So in domestic CDMO business, if you see there are some regulations coming up, and due to that there is a consolidation in domestic CDMO also. So our CDMO growth depends totally on our own capability, our capacity availability, and of course the price. So if you see we have the existing two facility in Baddi region. So one is cephalosporin and the other is general facility. In our cephalosporin facility, we are already operating at a higher utilization level. And in our general facility, we have the free and spare capacity. We are operating at 40 to 45% of the utilization. Compared to cephalosporin, there we are utilization is 70% approximately. So we estimate that 65, 70, 75% is the optimum utilization where the facility on the yearly basis can operate, looking at the seasonal variation also. So in the last year, our growth depend on our general block increase, quantity increase or volume increase. Vis-a-vis the price increase impact us negatively. So if you see, still we overall volume growth we have observed in approximately 10% in the last year also. That resulted into our EBITDA and PAT. So looking forward, we are relaxing our capacity of cephalosporin block with Jammu, and we are putting 3 more blocks. So we are very confident and hopeful that in the coming year or the next year we can grow at 20% plus in CDMO category also.
Mm-hmm. And for the industry, what has been the growth in your view last 2 years?
So if you see the market data, the growth in the pharma market is 3-4% only. Whereas in CDMO space, the bigger client is benefited with the consolidation also. So due to the revised regulation, the business is concentrating more towards the compliance side.
Mm-hmm. So is it right to say that the industry, I mean, as per the data what we have, the CDMO growth is around 7.5% for the industry, at least for the last 2 years, I mean FY21 to FY23 if I look at it. Now within that, the consolidation is going on, then our growth should be ahead of at least 7-8%, right? I'm just trying to get my numbers right.
So you can say that, but there is no clear-cut data visibility available by any research agency, I think. But due to this consolidation and free capacity availability, new plant introduction in Jammu, with the benefit of GST, we are very hopeful and confident to achieve 20% plus CAGR in the coming future.
While I agree on that, I'm just trying to understand why last 2 years, when the same thing is being played out, we haven't grown the Indian market.
So if you see that there is still double-digit volume growth in our business. But due to the COVID, the price get inflated like anything. For example, like paracetamol gone up to 600, 700 rupees. Now it is at 300 rupees. So the price is less by 40-50% in few of the API, right? So that top line impact is there due to that. And as we are working cost plus model, so we need to pass through the price benefit to our customers.
Got it, sir. So second, I see in your balance sheet that there is a high capital work in progress as well as an increase in capacity. I just want to understand the next coming year, I mean, how much you are investing and how one should think about it.
Yeah, that bucket should answer this. So, yes. So the capital work in progress that is been reflected in our consolidated balance sheet mainly represents the amount of capital that we have invested in our upcoming project in Jammu, so which is around 330 crores. So in the, as we discussed during the call, we are planning to start or commercialize our Jammu plant in Q2 FY25. So the overall project cost will be somewhere around 450 crores. So we are anticipating around next 100 crores in these coming quarters to be invested in Jammu plant.
Got it. And on a longer basis, maybe 3 years or 5 years out, what kind of taxation you think you would actually have on a blended basis, given that you are actually going to expand in Jammu and some few other places where the taxation will be lower? So how does it work the next, let's say, in next 5 years?
Yeah. So we, as on date, we will have the GST benefit from the Jammu plant. So approximately, say, 85-90 crores approximately will be the yearly GST benefits available to us. So on sale of, say 800 crore rupees, approximately we can say that 12% GST will be the reimbursement as per the central scheme. And other benefits will be like we have the few income tax losses benefit available in Canon Biomedicine.
Mm-hmm. So
and then we have the 235 crore project loan for Jammu facility that is at 6% interest payment. So these are the few benefits available to us by the government of India.
Got it. So another question is that because I think this year taxation came to around 27%, so that's why my question on this front. Now, the last question from my side is when client decides to give the contract to you or the other CDMO players, how does it work? Like, do you what is an advantage you would have over others? Is there a niche area where you are actually much better than the others, or you actually share clients across multiple other similar service providers?
So, client when selected the supplier partner, it totally depend on the technical capability, sales capacity, previous track record, previous relationships, and of course pricing. And based on all these, clients take select the partner to work with.
Okay. I mean, and in which areas we are stronger?
So let's say our plant are well quality compliant. We have the high certification like EUGMP also. And Jammu facility is also like say state-of-art facility with all the high automated machines like Romolag and all that. And as per the current CGMP norms, we have doing all the erection and commissioning of the facility. So we are far ahead with the or we can say that the facility is well state of art in the dosage from what we are offering to.
Got it. I put it slightly different. So when a client goes to Acrums or when the client comes to you, while these are the table stakes that you have to have, basic hygiene, basic quality parameters, etc., which you are. Now, is there a specific, therapeutic area or a particular science where you are better, or a particular dosage format where you are actually better than the others? or you have a stronger capability in terms of R&D, or just trying to from that angle?
So sir, when we talk about a major CDMO player, it all depends on the spare capacity availability, technical dossiers availability, technical know-how availability, and with the supplier relation, they select the vendor. And based on that, the business comes in.
Okay. Thank you, sir. I'll get back to you.
Thank you. The next question is from the line of Nitesh Dutt from Burman Capital. Please go ahead.
Hi, so thanks for the opportunity. First question is on our gross margin. So both for our standalone and console businesses, gross margins have gone up. So in standalone, I think the margins are now at 27% versus earlier levels of 22-23%. And as well as in console, the gross margins are now at 36%. So I just want to understand from your perspective, what should be the sustainable levels of gross margins, assuming normal prices, etc. So going ahead, what kind of GM do you expect?
Thank you. So generally, we in Innova, our gross margin historically remain at 25% plus minus 2-3%. So if you see increase in gross margin, that is because of totally there is decline in API but increase in volume. So if that situation reverse, so the gross margin could be like 25-26% range. And then if you see at a console level, that is because of the consolidation with the Sharon, as that business is in a regulated space, and we have the better gross conversion margin there in the Sharon Biomedicine. So looking forward, the range will be like for Innova, that will be like 25% plus minus 2-3%. And with Sharon, with Jammu, we have the benefit of GST. So 12% GST benefit is there. Something will be like a pass through to the customer. Some benefits will be passed through to the customer. Until we will able to manage some better GST benefit and can retain the GST benefit. So that will improve our EBITDA margin further.
Got it. And so for the existing business, right, if I split it in the 4 divisions, CDMO, domestic branded, international branded, and then Sharon, can you just give a rough idea on the gross margin? CDMO, you gave like 25%, but for the other segments, what should be the gross margin?
So, breaking with the different domain is a bit difficult for us because there is consolidated PHL. But we can say that we have the better margin in our own branded business, better margin in our exports, and better in Sharon compared to CDMO.
Got it. So next question is on the CDMO business, right? So if I look at an yearly level, FY24, FY22 is 30 CR, similar in FY23, and FY24 is at 622. Now I understand there is some impact of price decrease, but what you're effectively saying is there has been 10% kind of volume CAGR in the CDMO business. Does that mean that prices have corrected by 20% or so from the FY22 level? Is that a fair assessment? Got it.
So there are 2 factors, as I earlier explained also, that one is the price correction. The other is the product mix change. So say if I am making one product like 1 rupee per tablet or one product like 4 rupee per product. So if the product mix change, that also change my revenue number. And more or less our EBITDA margin is based on the unit economics.
So, but even at an EBITDA level, right? So if I look at the EBITDA of standalone in March 24, this quarter it was 23 CR versus 31 CR of last quarter, so roughly 25% degrowth. annual level, FY22 and 3, I think we were at 100 CR. FY24, we are at 108 CR in the standalone business. EBITDA also, we haven't grown that much. Rather, Q4.
So if you see yearly basis, IPL EBITDA grown from 107 to 118 crores. So there is approximately 10% increase in EBITDA in IPL standalone.
Okay. Standalone, you are saying it's 118. Actually, it was
118 compared to 107 last year. So there is a 10% increase in EBITDA compared to last year. So that you can say that like the cost of operation always increases year on year. The employee cost will increase, the whole operation cost increase. So maintaining in the same sale base in the CDMO, there is a 10% increase in EBITDA. So that is basically derived from the volume increase.
And typically during your pricing contracts with customers, is it the rupee EBITDA that you have fixed? So for example, if your cost of production is rupees 100, are you maintaining the fixed rupees or are you like charging percentage EBITDA, trying to maintain percentage EBITDA? So is it rupee EBITDA that's fixed or is it percentage EBITDA that you try to maintain?
Yeah. So there are generally two category of how we cost leads, like the bill of material cost, and then let's say we have the CCPC, conversion cost, packing cost, and then we have the profit margin. So the profit margin increase decrease with the API cost or cost bill of material, but CCPC is basically fixed and increase year on year basis. So you can say like 70% our profit margin is 60-70% profit margin is in or the gross conversion is in a fixed form, and 40% is in a variable form.
Sorry, variable basically relates to your cost of production.
Yes. Bill of material or cost of production. Yeah.
Understood. Last question from my side is on the other income this quarter. So I think we have had roughly 6 crore of other income. I want to understand the nature of this because the cash on books, I don't think it was that much. The ending cash was around 80 crore also. So where did this 6 crore come from and will it continue in future quarters?
Yeah. So our other income is basically, if you see there is a foreign gain loss, then government incentives on the export sales. Then there is a 64 crore, 63 crore I think approximately the FD, where we are increasing the interest from the fixed deposit as well.
So what will be the export incentive versus fixed deposit and if you can split it?
Yeah, that's nothing.
Talking about this 6 crore other income, so the major constituent is the FD income that we have generated. So see, out of our IPO, so let me take you slightly backwards. So our IPO proceeds were planned to be deployed spread over 2 years. So out of 293 crores of IPO proceeds, 62 crores were planned to be deployed in FY25. So that unutilized IPO proceeds along with some of our internal approvals, which come to around 70 to 75 crores, had been deployed in a fixed deposit till the time it is utilized in FY25. So that is bearing an interest. So that is one of the reasons of our increase in our other income.
Yeah. That's clear. Just one more question is on depreciation. So quarter on quarter, it has gone down from 5 CR to 3.4 CR. So
sorry to interrupt, Mr. Nitish. I request you to rejoin the queue for your follow-up questions. Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please limit your questions to 2 per participant. Should you have a follow-up questions, we will request you to rejoin the queue. The next question is from the line of Harshit Zaveri from PI Square Investments. Please go ahead.
Congratulations, sir, for the good set of numbers. I just wanted to understand that we are coming up with new phases in the Jammu and Kashmir, which will have a greater contribution of the overall CDMO space at the consolidated level. And with the falling API prices and the lower margins in the CDMO space, what type of margins do we expect as a consolidated level for the next 2 to 3 years? Hello.
So, see, if I talk specifically about Jammu, so Jammu, while it's a decided location, the manufacturing capabilities at the same time, business model will remain as the core CDMO. So, on a business as usual basis, we look at the same margin profile as we are carrying on in our existing model. But considering the added incentives that we are going to accrue in Jammu, which is basically the GST benefit, and to be more specific, we are expecting, since we may be able to claw back some of the incentives to our margins, despite passing some of the portion to our customers. So we are looking at a better profile, my margin profile in Jammu as compared to our existing business.
Understood, sir. And sir, as an industry sector, what's your take on how long the API downturn will continue? So are you expecting another 1 to 2 years of these lower prices, or do you expect the prices to stabilize and then go up again?
So during the COVID period, price get inflated, and in the last 1 or 2 years, we have witnessed that the price has declined. And we expect that next year the base should be there should not be any further decline in the prices. That is expected as the market is also speculating the same thing, that the further price degradation should not happen in the market.
Understood. And sir, do we expect the export share to remain the same, or we are planning to increase the export?
So our export revenue?
Correct, sir. So currently around 23 to 25% of export.
Yeah. So we are working focused on all the verticals of our business operation, whether it is our own market, domestic business, or CDMO, or international sales. We are equally focused and concentrated on all the three of which are on the whole 4 verticals. And each business is growing its own at a healthy rate, right? So in the future, if some business segments grow at a faster pace, then there can be a 1 or 2% fix in our overall book.
Okay, understood. And just last question. Sir, we are planning to spend another 100 to 120 crores for Jammu in this year. Do we also plan to spend any other maintenance capex? Obviously, a smaller sum, but how much do we expect to spend for the maintenance capex of the existing plant in Baddi?
So our normal maintenance capex, we should be in range of around 5 to 7 crores per annum, not more than that.
Okay, sir. And another 100 crores in Jammu.
Yeah, this is still there.
Okay. All the best.
Yeah.
Thank you. The next question is from the line of Miten Lathia from Fractal Capital Investment. Please go ahead.
Good afternoon, sir. What would be our FY24 chronic acute mix, and what would we expect it to be after our Jammu facility comes online?
So chronic acute mix, if you see in the CDMO, it will be not classified chronic acute, but still our acute is 50% and chronic is 50%. And with Jammu, our acute will increase further as most of the infection in Jammu is from the antibiotic side.
Got it, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Jainil Shah from JM Financials. Please go ahead.
Yeah, hi. Thank you for the opportunity. So, sir, our working capital days have significantly improved. Is this sustainable now, and is there room to improve this?
So, yes, our working capital. So I will talk more on the cash management cycle. So since we have deployed successfully our IPO purchase and while maintaining the operational efficiencies and keep on working on those efficiencies, we are looking to be in the range in which we are existingly operating in a good level, slightly here and there.
Sure. And just one more question on the CDMO piece. Our revenue from CDMO customers, with whom we have a relationship for 5 to 10 years, it has seen a dip. Any specific reason that you would like to call out over here?
So, Jenny, can you please repeat your question?
So, in our presentation here, we've shown revenue from CDMO customers who have been with us for 5 to 10 years. There is a dip this year. Any specific reason that you would like to call out?
So, if you see our relationship, so revenue from CDMO customers more than 10 years has been increased. So it is more of the shift from 5 to 10 buckets to more than 10 years. So that is the bigger reason.
Okay, but nothing specific on that particular
No.
right?
So if the relationship is there for 9 years, now that relationship has shifted with 11 years. So there is a column shift. If you refer the third column, greater than 10 years, so there is an increase from 239 to 279.
So it's mainly a reclassification.
Yeah, reclassification what we get. So it is more of an aging thing. If you the way we look at our aging, so we normally gauge the relationship on the day which we have started our first billing with the customers. So most hopefully in the coming year, so since we always I will take it as a positive side because normally we work hard to maintain and retain our customers. So slowly and steadily, the customer which is less than 5 years will move to 5 and 10 year buckets, and then further it will move to greater than 10 year buckets.
Got it. And just one last one. What's the EBITDA margin for Sharon in this quarter and for FY24?
So EBITDA margin remains in the range of so for FY24 for 3 quarters that we have reported, EBITDA margin stood at around 24%, and for quarter 4 it is in the range of around 26-27%.
Yeah. Okay. Thanks.
Thank you. The next question is from the line of Nitin Gandhi from Innova Advisors Private Limited. Please go ahead.
Thanks for taking my question. Regarding the Jammu block, what is likely to be the optimal revenue against 450 crore block?
So, looking at the past, we used to do 4 to 5 times of the sector. So this block is capable in doing the same asset turn. And in the 3-4 years, we are looking at a revenue of 1,000 crore plus.
Okay. And what is the share on net profit? Because you said accumulated loss is somewhere high. So can you share that figure also?
So accumulated losses is basically when we acquire it from the CIRP, IBC process, that time it is all cleared. Right? So now this year our net profit was
Lokesh give you the figure. So for FY24, our net profit for 3 quarters that we have reported, Sharon has clocked a PAT of around 12 crores. See, when we say about carry forward losses, it's more of a benefit since Sharon was in IBC for last so many years and there had been some accumulated losses and that taxation benefit has passed on to after acquisition through our IBC process. So, yeah.
So can you share that number? What is accumulated loss which you will be setting off?
So it's a range of around 20 to 25 crores.
25 crores. Okay, so that will be set off this year. Okay. Thank you.
Thank you. The next question is from the line of Karan Shah from GC Holdings. Please go ahead.
Thank you for the opportunity, sir. So just one question. How are we seeing the inflows in the new inquiries from new customers and for new products across geographies and especially for the Indian geography?
So then, as you see that we are already working with 14 top customers and we have a healthy relationship with all the pharmaceutical companies. And we are discussing our Jammu facility and we are getting very good feedback from most of the customers. And in pharmaceutical, generally there is no pre-agreement. Once we start the facility, then they do the audit and orders start flowing to us. We are in advanced stage of our discussion, and once we start our commercial production, immediately the relationship will start there in Jammu also.
And sir, what about the existing facility at Baddi? Because we see there is huge headroom for increase in utilization as well.
So let's see, like as earlier also I explained that we have the two blocks, cephalosporin and general. So in general, we have the spare capacity. We are working at a capacity of 40-45%, whereas our cephalosporin is at a higher utilization. So we look forward to improve our general facility utilization in Baddi.
So are we getting new inquiries which are getting converted for the existing facility as well, right?
Yes. So that's that is increasing the wallet share with our existing customer, onboarding the new customer, increasing the product number of SKU, number of products with the new and existing customer.
Okay, that's helpful. Thank you, sir.
Yeah, thank you.
Thank you. The next follow-up question is from the line of Nitesh Dutt from Burman Capital. Please go ahead.
Hi, thank you for the opportunity again. I just had one question on our depreciation this quarter. So it has gone down from, I think, 5 crore last quarter to 3.4 crores. So just want to understand if there have been any write-offs or anything else.
No, and this, so the lower depreciation mainly on account of Sharon, which they have done due to some realignment with our group policy, accounting policy. That is all.
Understood. So the 1.5 year change is because some accounting policy has changed. For example, increasing the life of asset, etc.
No. It is not like this. Basically, when we acquired Sharon, so they were on some different accounting policy. Now, as it is part of our Innova group, so this quarter, the auditors, with the help of our auditors, we have realigned their accounting policy with overall group's accounting policy, and this is just an impact on Sharon production. That's it.
Clear. Thanks.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Vinay Lohariwala for closing remarks. Over to you, sir.
Yes, thank you. Thank you everyone for joining us in the earnings call. We appreciate your time and showing interest in our company. In case of any inquiry, you can get in touch with us or SGA, our investor relations advisor. We look forward to meeting all of you over the next call. Thank you. Thank you.
Thank you. On behalf of Innova Captab Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.